The Indian economy right now is a real head-scratcher. It's this massive puzzle that has even the sharpest analysts baffled. On one hand, you've got this incredible powerhouse growth, and on the other, a currency that's just tumbling. So today, we're going to unpack this mystery piece by piece.
So here it is, the core of the paradox. India puts a blockbuster 8.2% GDP growth number on the board, just crushing all the estimates. But at the exact same time, the rupee hits an all-time low against the dollar. So what's the real story here? Is the economy absolutely booming, or is it actually in some kind of trouble? Which one is it?
I want you to think of it like a giant tug-of-war happening right in the middle of the market. On one side, you've got this powerful engine, that 8.2% GDP, just pulling everything forward with all its might. But on the other end of the rope, there's this heavy anchor, the rupee sinking to almost 90 to the dollar. And these two massive forces are colliding, basically tearing the market in two completely different directions.
All right, so let's break this whole thing down. First up, the bull versus the bear. We're going to look at these two big headline forces that are pulling the market apart.
Let's start with the bull case, the good news, that 8.2% GDP growth. And to be really clear, this isn't just a good number. No, this is a global headline maker. It's a huge signal that while a lot of other major economies are kind of slowing down, India is forging its own path. We're decoupling.
So what's really driving this bullish engine? Well, it comes down to three things. First, this incredible growth, it justifies why investors are willing to pay a premium for Indian stocks. Second, it's proof that the private capex cycle, that's just a fancy way of saying companies are finally investing big money in new factories and equipment, is kicking into high gear. And third, a number this strong is just really hard for foreign investors to ignore. It could be the very thing that reverses the recent flood of money leaving the country.
But then there's the bear. The rupee hitting a gut-wrenching record low of 89.5 to the US dollar. For any foreign investor looking at India, this is a massive, flashing red flag.
You see, a falling currency is just toxic for foreign investment. I mean, think about it. If a big fund from New York or London, what we call an FII, owns Indian stocks, a falling rupee literally erases their profits when they convert their money back to dollars. So what do? It forces them to sell. It also kicks up major fears of imported inflation, and it causes this big shift in the market as money runs away from domestic-focused companies and rushes into exporters like IT and pharma because they actually benefit from a weak rupee.
And this brings us to Section 2. Because the real story here, the one that truly matters, isn't in those big, flashy headline numbers. No, it's in the hidden clues, the invisible forces moving the market just beneath the surface.
And this chart right here shows the biggest hidden factor of all, an all-out institutional war. On one side, you have the foreign institutional investors, the FIIs, dumping stocks at a record pace. Now, normally, that would absolutely crash the market, but look at the chart. On the other side, you've got the domestic institutional investors, the DIIs, fueled by all of our own SIP money, and they are buying up every single share the FIIs are selling. This DII shield is what is single-handedly holding the entire market up right now.
Now, here's the second hidden clue, and it's a tricky one, the paradox of profitless growth. So GDP is way up, which means companies are selling more stuff, right? More cars, more phones, more everything. But, and here's the catch, high costs for raw materials are squeezing their profit margins. So even though sales volume is fantastic, their actual profits are flat. And since the stock market ultimately follows profits, not just sales, the market feels heavy and stuck, even with a booming economy.
And it's not just what's happening inside India, right? There are a couple of other global factors at play. First, a super strong US dollar is basically acting like a vacuum, pulling money out of markets like India. But we have a silent savior, crude oil. Our massive reliance on imported oil means that these surprisingly low global prices are acting like a huge subsidy for the Indian economy, and that's what's keeping a lid on our inflation. For now.
This brings us to Section 3. Let's trace how that weak rupee can create a domino effect that eventually hits your own wallet.
It's actually a pretty simple three-step journey. First, the rupee weakens. Second, since India imports something like 85% of its oil plus tons of electronics, the cost of bringing those things into the country goes up. And third, what do companies do? They pass those higher costs on to you. The price of everything from the petrol in your car to the biscuits you buy goes up. And that right there is imported inflation.
So this table, it basically breaks down the inflation pipeline as it stands right this second. Now look at stage 1. The currency is clearly in the red, high danger. But, and this is really important, that pressure hasn't yet passed through to the factory gates or to consumer prices. See? They're still in the green. So the fire is at the border, but it hasn't spread into the city yet. The entire market is now holding its breath, just watching and waiting to see if the central bank, the RBI, will be forced to step in.
So with all these different variables in play, you have to ask, how does this all end? So let's jump to section 4, where we're going to map out the most likely scenarios for the Indian economy from here on out.
As you can see, there are really 4 main paths from here. You've got the nightmare scenario, a weak rupee plus high inflation, which would lead to a crash. The dream, of course, is Goldilocks, a stable rupee, low inflation, and a roaring bull market. Right now, though, we are in the anomaly, that really strange mix of a weak rupee but low inflation. And that's thanks almost entirely to that cheap oil we talked about. Understanding these paths is absolutely key to knowing what might come next.
All right, so that's the big picture. Now for section 5, and this is the important part, your strategic cheat sheet, the key things you need to be watching right now. Okay, the next 10 days are, and I'm not exaggerating, absolutely critical. We've got the OPEC Plus meeting on oil production, we've got the RBI's interest rate decision, and we have the US Fed meeting. The outcomes of these 3 events are going to set the entire direction for the market for the next few months.
So based on what happens in those meetings, here's a little portfolio cheat sheet. If the RBI decides to hold rates steady, that's generally seen as a negative for banks, but a positive for IT. If the rupee breaks that crucial 90 to the dollar level, the classic playbook says to favor exporters and avoid importers. And if oil suddenly spikes above $75 a barrel, the strategy is simple. Cash is king.
You know, if you take away just one single thing from all of this, let it be this quote. The Indian market today is being fueled by a powerful, massive wave of domestic liquidity, but it's being capped by a hard ceiling of global fear.
Which leaves us with the final, multi-trillion-dollar question. The next move belongs to the central bankers, both at the RBI and the US Fed, and they face an incredibly tough choice. Will they make decisions to protect that amazing 8.2% growth, or will they be forced to sacrifice that growth to save the currency? Their answer is going to determine everything.